In today's deep dive, we're examining Hangyang Co. This is a company undergoing a significant business transformation, a transformation that, according to the data, the market may not have fully recognized. Our analysis will focus on this growing gap between perception and reality. Our entire analysis rests on a 4-point thesis. Point 1, Hangyang is making a fundamental pivot from a cyclical equipment maker to a much more stable gas utility model. Point 2, the financials back this up with a clear shift in revenue and, importantly, explosive growth in cash flow. This leads to point 3, a significant valuation disconnect appears to have emerged. And finally, the 4th point. The company's core deep cryogenic technology represents a long-term option on the future that appears to be completely unpriced by the market. So, here's our analytical roadmap. We'll start with the transformation itself, then look at its 2 business engines. From there, we'll examine the cash flow as proof, decode the valuation, and finally, touch on a hidden option for the future. All right, let's begin with Section 1, the company's transformation, and what we're calling the market perception lag. This slide really gets to the heart of the issue. The old perception, the one that still seems to linger in the market, is of a cyclical, heavy equipment manufacturer tied directly to macroeconomic headwinds. But the new reality, supported by the numbers, is that of a hybrid company. And the crucial part is this growing utility-like gas business that's now providing stable, long-term cash flows. So what's behind this shift? Let's move to Section 2 and deconstruct the business model, what we're calling the 2 engines. And here, the data speaks for itself. If you look at the numbers, back in 2022, the gas segment was about 53% of revenue. Fast forward to the first half of 2025, and that share has jumped to nearly 63%. What's important here is that this isn't just a blip, it points to a structural change in the company's revenue composition. This chart visualizes that trend perfectly. You can see the decisive climb, making it very clear that the gas segment has become the primary driver, the main engine for both growth and, critically, for stability. Now, this isn't just about 2 separate businesses under one roof. There's a powerful synergy here that creates a competitive advantage, an integrated moat, if you will. Because they manufacture their own equipment in-house, their gas services division gets a structural cost advantage. This makes them much more competitive when they're bidding for those crucial long-term contracts. Okay, so the business model has shifted. But what's the tangible results? For that, we need to follow the money. Let's move to Section 3 and look at the cash flow, which we see as the ultimate proof of this transformation. And here is the headline number, a 97.8% year-over-year increase in operating cash flow for the first half of 2025. You know, that's not just incremental growth, that is a significant acceleration. It suggests that years of capital expenditure in the gas business are now starting to pay off in a big way. This, right here, is the financial evidence we've been talking about. So the natural question is, where does the stability come from? The answer lies in the structure of their contracts. They're called take-or-pay contracts. Essentially, these are very long-term agreements. We're talking 15 to 20 years, where clients contractually agree to pay for a minimum amount of gas, regardless of whether they actually use it. This structure is key because it effectively de-risks the revenue stream, making it highly predictable, much like a utility. And this leads to a powerful analogy for understanding the shift. The company's financial foundation is starting to look less like a resources company exposed to volatile commodity prices and much more like a power plant that's backed by long-term power purchase agreements. This insulation from short-term volatility marks a fundamental change in its financial character. Okay, so if the business model has changed and the cash flow proves it, that brings us to the next logical question. Why does there appear to be a valuation discrepancy? To get to the bottom of that, we need to decode the valuation, which is our 4th section. The core analytical problem is this. How do you properly value a hybrid company like this one? If you just apply a single blended valuation multiple, you risk obscuring the true distinct values of its 2 very different components, the stable part and the cyclical part. And a quick look at the global industrial gas peers puts this in context. You see major players like Linde and Air Liquide trading at trailing PE ratios of roughly 33.5 and 29.5 respectively. In contrast, Hangyang is trading at around 25 times. This suggests the market may still be pricing it differently, perhaps not fully accounting for its growing gas business. This is why a more granular approach is needed. And in our view, a more suitable tool for this situation is the sum of the parts analysis, or SOT. It allows us to value each business segment individually. The SOTP methodology itself is quite logical. Step 1, you value the stable gas segment separately, using a multiple that's appropriate for a utility-like business, let's say in the 20 to 25 times PE range. Step 2, you value the more cyclical equipment segment using a more conservative multiple, perhaps 12 to 15 times PE. And step 3, you simply sum those two values and make any necessary adjustments for corporate items. Now, running this SOTP analysis, based on market prices from late September 2025, points to a potential valuation disconnect of around 29%. This isn't a price target, to be clear, but it does quantify the potential degree to which the market might be undervaluing the company by not looking at its individual parts. But the story doesn't end with the current valuation. There's one more layer to this analysis. Let's move to our final section, what we call the future's hidden option. So what is this hidden option? Well, it stems from the company's fundamental core competency, which is deep cryogenic technology. This isn't just about their current business. This expertise is foundational and potentially connects them to some major industries of the future. Think of this competency as a technology option on the future. Let's look at some examples. Controlled nuclear fusion. That requires massive scale cooling for superconducting magnets. Quantum computing? That needs extremely low temperatures for qubits to operate. Aerospace, advanced materials, they all rely on cryogenic systems. Hangyang's expertise is a potential enabling technology in all of these frontier fields. So to put it another way, the current valuation provides a stake in a robust, cash-generating industrial business. But it also seems to come with a, for lack of a better term, zero-cost option on these future disruptive technologies. It's a latent potential that doesn't seem to be factored into the current market analysis. All right, let's summarize the key analytical takeaways from our deep dive. First, Hangyang's business model has made a fundamental shift toward a more stable, cash-generative profile. Second, the financial data, especially that explosive operating cash flow, offers clear evidence. Third, a sum-of-the-parts analysis suggests a potential disconnect between the company's intrinsic value and current market perception. And finally, the company's core cryogenic technology represents a latent and seemingly unpriced option on future technological demand. And all of this brings us to one final, broader question. When a company's fundamental nature undergoes such a significant change, how long does it take for the market's perception to finally catch up? It's that lag, that gap between operational reality and market perception, that lies at the very heart of this analysis.